level, and that has not happened.
In our remaining moment or so, Ashley, we see wage gains cooling to some of the lowest levels in more than a decade, according to the J.P. Morgan Chase Institute. Younger American workers bearing the brunt of the slowdown. You mentioned prices. When you combine that with wages, how do they collide for the midterms?
I mean, listen, we have to wait and see, but I do think that the wages are going through a correction. Obviously not in some sectors. If you are in the AI sector, you're getting paid. Doing
pretty well.
You're doing very well, and you're being sought after by many different companies. But yeah, I do think there's a course correction here. But also, what I'm watching is some of the DOGE impacts that have happened. Listen, have always said, Joe, that federal government was too big. Whether you agree how it was handled or not through the DOGE stuff, like, that's one thing.
Yeah.
However, what's happening right now is through DOGE and the government cutting back is you see some of these major consultancies, EY, Accenture, really letting off a lot of their people because there isn't that money just flying out the door from
Even
the federal
some
government.
of the Mag 7 been laying off, if you look at what we saw from Amazon.
With Amazon.
Ashley Davis, Jeannie Shanzano, many thanks to both of you for a great panel, a special edition of Bloomberg Surveillance.
In case you missed it on Bloomberg Brief.
This is a big difference from April. Remember when there was no place to hide? And now, even though the 10-year is below 4%, if you start to see the labor market showing signs of firing, whether government or the private sector, I think then the 10-year has a lot of room to decline because then the Fed's cutting into accommodative territory, not just getting to neutral.
Don't miss Bloomberg Brief, live every weekday.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live on TV and radio, counting down to another Fed rate decision at Chairman Powell news conference. That decision 27 minutes away. The news conference 30 minutes after that. Equities going into this at all-time highs on the S&P 500.
I look at where we are, John, and I just have to state that the Fed balance sheet is everything today.
QT on the cards, potentially ending that a little bit later on this afternoon. That's going to be a focus for many people in this market. Just how much guidance can they offer you going into December, given the limited amount of economic data? Think about where we are right now. GDP, close to 3. Inflation, close to 3. Equities at all-time highs. And this Federal Reserve, TK, is about to cut interest rates all over again.
They're going to cut over again, and you wonder what the dissents are. You wonder if we see Marion here down to 50 beeps again, as we've discussed many times. But this morning, John, I'm sure you saw it as well. Check after check after check is about the Fed balance sheet. Never have we had a Fed meeting so focused on QE. What did Nouriel used to say? QE1, QE2 with that accent is. That's where we are.
TK, there's only so much they can say without economic data. They just can't offer guidance about a December decision. So the focus has shifted, I think, for the market elsewhere. The bulk of economists that we've surveyed here at Bloomberg, at least on this program, have suggested that decision may come in December. Maybe even the new year. Is October too soon?
I see a lot of parlor game on January and into the new year. How can we do that? We are absolutely blind. I know we're making it up as we go. What did I see? ADP's coming out with a weekly statistic? You're kidding me. We're blind on the labor economy.
Let's turn to the markets. On the S&P 500, potentially a 5-day winning streak on the S&P right now. Record highs across the board. On the Nasdaq, up by 0.3. For the Nasdaq 100, the attention is going to shift to the tech earnings after the closing bell a little bit later. Before we get to that, we need to deal with this interest rate decision later on this afternoon, just 25 minutes away. Coming up very shortly, we'll catch up with JP Morgan's Bob Michael, Kathy Jones of Charles Schwab, and SocGen's Subhash Rajappa. They'll take us into this decision at 2 p.m. Eastern Time. Then immediately afterwards, we'll speak to the former Fed Vice Chair Rich Clarida, Diane Swank of KPMG, Deutsche Bank's Matt Lazzetti, and the post-game conversation. On set in the studio, Apollo's Torsten Slok, BlackRock's Jeff Rosenberg coming up.
It's a great list. I don't know who in those guests are on the chairman list. I mean, we got to move it out from 5 people to 6 people. I'm sorry. Where is Clarida? Well, how can he not be on that list?
I think maybe maybe things have changed down at the Federal Reserve, TK, the kind of names in the mix. Secretary Bessent's name is still doing the rounds.
Neil Dowda heated on this.
The longer this goes on, Anne-Marie said this a few times, the longer this goes on, the more likely it will be that it could be the Treasury Secretary.
It's an eclectic mix. I give him credit for that, but there's some names that are obviously missing. How you can not have the gentleman from PIMCO in Columbia not on the list, I just think is absurd.
Rich Claret just around the corner with us right now. Bob Michael of JP Morgan Asset Management. Good afternoon, Bob. Good to see you.
Happy to be here.
What are you focused on and what are you expecting at 2 p.m. Eastern Time?
What we're expecting at 2 is a 25 basis point rate cut, and they're going to end quantitative tightening at the end of the month. I think those are pretty much baked into the markets. What are we looking for? It's all going to be about the post-meeting statement and the number of dissents. Are we going to see just Stephen Myron frozen out by the rest of the FOMC and that one lone dot? I think pointing to 75 basis points in rate cuts, and everyone else at 25, or are we going to see a couple others down in the 50 basis
Do you
point
think
rate cut
Dissent
cap?
can cut both ways at this particular meeting?
I don't think so. I think the Fed believes that this is a risk management exercise. They've seen some softening in the labor market. They do believe that the neutral rate is somewhere below where they are now. So 25 basis points to me looks like the obvious place to go. I don't think there are going to be any dissents to the hawkish side.
With all your experience, we have a shutdown, we're blind, and we clearly have two Americas. The food line stories are heartbreaking, weighing in November 1. We've got a military that may or may not get paid. Who does the Fed think about today when they make this decision? Who does the chairman address at the press conference?
Well, I think they think about the broader economy, and they look to relieve pressure on businesses and households. So bringing down the Fed funds rate by 25 basis points does have an impact on corporate America.
Yes.
A lot of corporate America, we know from private credit, a 50 million EBITDA company could carry 350 million worth of debt. So it means a lot. And if businesses feel that the pressure is being relieved, then they may start hiring again or retain their workforce into year end, into the One Big Beautiful Bill Act.
So that tells me this is a snooze fest this afternoon, but it's not, because his mandate, given the politics of the nation and the national uncertainty, is he's got to get out front and surprise with a more dovish cast.
Perhaps that comes out at the press conference.
Yes, at the press conference.
I don't know, because as John started off, equity markets are at a high. Credit spreads are very tight. The labor market, you look at the low fours unemployment, 4.3%, doesn't look bad.
I got a question for you. Given everything we've got, John, what would the dissent be at the Bank of England today if they had the same cards? There'd be visible back and forth.
So I think this is potentially a question for next year. I remember a time when Governor King dissented on his own committee and was pushing for more QE, and his committee was voting against him. And maybe that's a question for 2026. If you get someone super dovish in the seat for 2026, can he get the rest of the committee to come with him? I think a question for today, Bob, is just how divided this committee is. And you point to the labour market, and I'm right there with you. There are credible arguments today to cut interest rates. Equally, there are credible arguments to do absolutely nothing. And when you look at the labour market, it's massively dependent on which data point you're anchoring your view around. If it's payrolls, you are spooked. You are cutting interest rates. If it's unemployment, you're sitting there saying, you know what, I don't think the slack has increased too much here, even with this massive step down in payrolls, and I don't see the urgent need to reduce interest rates. How would you anchor your view around this labour market?
I anchor my view around JP Morgan Chase data. We're the largest banker to the consumer. We're not flying data blind at all. We see the top 4 quintiles of earners with deposit balances above where they went into COVID. The bottom quintile is below where they went into COVID. So that's the K-shape we all talk about. Does that get addressed with the One Big Beautiful Bill Act when you start to see tax filings and refunds on tips, overtime, Social Security payments, and a host of other things? Maybe it does.
Are you in the re-acceleration camp for 26? Are you expecting things to pick up in the new year?
Yeah, I think the fourth quarter of this year and the first quarter of next year will be, call it 1 to 1.5% GDP. There will be some digestion of further tariffs and final tariff policy. But with central banks cutting rates and an additional $1 trillion in stimulus hitting, it's hard not to see a reacceleration in growth.
What does yield tell you right now, not only the conventional full faith and credit, but the very short-term paper, the trust market? What are the indicators you see into this meeting?
The planet is underallocated to fixed income. I just got back from the Middle East. I heard it everywhere I visited. I hear it domestically. I've got one meeting after another. How else do you explain the 10-year trading through the Fed funds rate today? It can only happen if there are constant buyers, and the buyers are out there in full force.
Then how does that cross over to the dollar as an indicator of that need to buy more paper in America?
Well, I think that's a different topic, because there is a sense that perhaps if you're an overseas investor and you accumulated U.S. assets, you may look a little toppy in dollar exposure. So why not hedge some of that back to your base currency? It didn't make sense a couple years ago because the dollar kept going up, so you hung on to the dollar with U.S. assets. Now they're starting to hedge some back to their base currency.
Bob, logic would dictate, as the Federal Reserve begins to reduce interest rates, that money and money market funds would start to spill out, maybe into risk assets, into other things. How sticky is that money at the moment?
Well, other things would be fixed income,
of course,
in my
yes.
view.
Yes, the Bob's Fund. Forgive me.
Yeah, and that is a pressure that you hear from clients, that they've held cash for a while. They feel they may have missed interest rates. I tell them, congratulations, you were right. Why would you have held fixed income in negative yield environments? And then in 2022, 2023, rates were going up and bond prices were going down. You can still get in substantially higher than where we've been over the last 10, 15 years, although you've given back only 1% or so of the 500 basis points of rate hikes. And there are lots of things to buy. There's still credit to buy. That gets you closer to 5%. There's emerging market debt to buy. That gets you 10, 12%.
Quick, John, the Bloomberg Total Return Index is the Bob Michael chart. The appreciation of bonds and fixed income back over the last 2 years, nobody saw that coming.
The flows into Bob Michael of JP Morgan Asset Management's business has been pretty persistent, I think, for the year so far. Bob Michael of JP Morgan Asset Management is going to stick with us into this decision. That decision is 18 minutes away. That news conference is 30 minutes after that. Up next, the conversation with Kathy Jones of Charles Schwab, together with Subhadra Rajappa of SocGen. It is Fed Decision Day. Live from New York City this afternoon. Good afternoon.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, special contributor Larry Summers on the Fed decision and the Trump-Xi meeting. What President Milei's victory in Argentina means for investors and for the United States. And the godfather of AI, Jeffrey Hinton, on why what he helped create could mean the end of us all.
We should be a lot more worried than we are. How are we going to coexist with these things?
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In case you missed it, on Bloomberg Tech Europe.
Well, I would argue that our odds are pretty good at winning a big market share. But of course, some incumbents will manage to reinvent themselves, right? I think Jamie is on to something really exciting. He's trying to do it now. Solomon was trying with Goldman Sachs, but then kind of Marcus, was thrown out when the fintech valuations dropped down. A lot of banks stopped their aspirations in fintech, and now they're waking up to that fintech never died.
Don't miss Bloomberg Tech Europe every month.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, special contributor Larry Summers on the Fed decision and the Trump-Xi meeting. What President Milei's victory in Argentina means for investors and for the United States. And the godfather of AI, Jeffrey Hinton, on why what he helped create could mean the end of us all.
We should be a lot more worried than we are. How are we going to coexist with these things?
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Fed wants to cut interest rates.
We know the Fed's going to cut interest rates.
The Fed is going to cut.
The Fed we believe, is going to cut.
And I would cut.
They cut 25 basis points.
They're expecting to be lower over the next few quarters.
The most natural thing to do is to continue on that path.
It's very pragmatic for the Fed to be delivering what's priced into markets.
If you look at the economy itself, we're slowing down to a crawl.
Labor market activity has slowed quite dramatically.
Labor demand is cooling.
We're waiting for that next shoe to drop.
The risk for the Fed is to have a repeat of last year.
They're going to be very flexible in their message.
You have to go off the data that you have. And I know that's very tricky, and it puts the Fed in a very tricky position.
We don't really know how they're using the data that they do have right now.
Data or no data, you still have to make policy.
It's a tough situation for the Fed at the moment.
You might see dissents on both sides at this meeting.
They have to be pretty careful about how much they signal more cuts going forward.
Just how much can they signal at this meeting? That's the challenge for the Fed Chair Jerome Powell. That decision 15 minutes away, the news conference 30 minutes later, going into it, 5-day winning streak on the S&P 500. Equities this afternoon higher by 0.2%, on the Nasdaq up by 0.3%. TK in the bond market, 2s, 10s, 30s. Interesting, the last time the Fed met, 2s at 350, 10s at 4%. This bond market has been very well behaved over the last month.
I don't like the word, but I'm going to use it here, resilient. And the answer is there have been some movements, including a dash to lower rates. But we come back, and again, I look today at weaker sterling and stronger renminbi with what's going on in Korea. And there's just a churn here that shows a resilient economy. As Bob Michael said, you model out Q1, Q2, and you say, okay, we keep it going.
I think Bob's right. Bob Michael at JP Morgan still with us, by the way. Look at what we're hearing from corporate America. Let's take the banks, Bob. Banks are telling us that corporate clients are re-engaging big time. If you look at Visa, just to stay with the financials, they're saying the consumer is still engaging and is likely to engage into year-end and beyond. Is that the tone you're picking up from corporate earnings? Just how bifurcated are things?
Forget about corporate earnings. Our analysts, credit and equity analysts, are talking to companies every day, dozens, hundreds of them every week, and we're all hearing the same thing. Tariffs are yesterday's news. They've absorbed it. They're over the hump. They've stopped moaning. They're getting on with life. And they've underinvested in themselves this year, deliberately. It's flattered earnings. Now it's time to invest. Maybe there's more CapEx in AI. There's a bit more hiring to go. They'll see how it all plays out, but they're not seeing the consumer fall off a cliff here.
Subhadra Rajappa of SocGen joins us now for The View from SocGen and a whole lot more. Subhadra, welcome to the program. Let's just start with the basics. In about 13 minutes' time, a decision, a statement. How much dissent are you expecting this afternoon?
Probably one dissent from Governor Myron for a more deeper cut, because he's been calling for the Fed funds rate to be moved down to neutral. There could be some dissents coming from some of the regional Fed presidents, but I think it's unlikely. I think the last meeting was very clear that Chair Powell was able to build a consensus, and I think this time around, the likelihood that we see just one dissent is what I'm expecting.
Subhadra, I'm fascinated where this fits in within the international landscape. Each story is different. The United Kingdom, the ECB, who knows what's going on in Japan with the new government as well. How much is Jerome Powell central banker to the world at 2 o'clock today?
He's always the central banker to the world. Of course, I'm a little bit biased coming from the U.S. because everybody, my colleagues in Paris, are going to be up late watching the Fed meetings. So I think that policy in the U.S. is going to be very important. That said, we're watching what the other central banks are doing as well. The Bank of Japan's been quite interesting this year. The ECB looks like they're almost done easing. So the Fed definitely leads the way, and you're seeing that price action in the bond market as well, where treasuries are rallying while other global bond yields are actually rising, and you're seeing that spread start to widen a bit.
There's a backdrop, Bob Michael, here. I read very carefully, I think in the FT, about JP Morgan's new retail effort in Germany. Fascinating to see what digital banking is going to do. But part of it is a bang-up year for EM, a bang-up year of prosperity across the emerging markets, at least in the equity markets, as well. So Jerome Powell, he's getting it done. Maybe even President Trump's getting it done. He's central banker to the world. That's all there is to it.
It feels like it, and also emerging market debt has performed very well too. But it also feels to me that something's different about the ECB this go round. And I think Christine Lagarde looks at the ECB and looks at Europe and says, the sands are shifting. We have to ring fence Europe ourselves and deal with what's going on in Europe. So I expect them to veer away from the Fed over the coming year or so.
Extremely well said. And this is John. How much of the Draghi mandate has Europe actually got done?
Not enough.
Not enough.
Not enough. You know, the narrative around Europe this year is so interesting. I think it's been defined by much of the price action of the first quarter of 2025. If you look at the forecast from the ECB, you mentioned the European Central Bank, let's go through them. Real GDP for 2025, 1.2%, 26, 1%, 27, 1.3%. If Chairman Powell was putting out forecasts like that in this news conference later on this afternoon, he'd be flat out embarrassed. And we've got analysts and strategists coming on the programme celebrating a new dawn for the European economy. Bob, that feels like a stretch based on the ECB's own forecasts. Is it a stretch?
Well, since those forecasts, you've also had Germany announced that they're going to embark on quite a large fiscal spend. You've got much lower policy rates now. I think you have to look across Europe and watch. I also think that the ECB is in a position where they could push through more unified issuance, create a joint vehicle that can fund projects across Greater Europe that rather than being raised in one particular region or another. So I expect good things to come out of Europe in the next year or so.
The focus this afternoon, of course, on the Federal Reserve and the US Central Bank. That decision 10 minutes away. Subhadra Rajapra of SocGen still with us. Subhadra, TK said it at the top of the programme. It's about QT. Potentially today, maybe you've got to wait until December in early next year. Is today too early, Subhadra, to make that call to end QT?
It's not too early, but I wouldn't be surprised if they decide that they want to wait. I mean, I don't see the rush either. I mean, yes, you are seeing some pressure on the repo markets. You are seeing the availability of collateral go up because there's been a lot of bill supply. The Fed could quite proactively engage in ending QT. But they can potentially employ other tools like temporary open market operations to allay some of the fears in the repo market and perhaps have a later start. Either way, the way I look at it is it's $5 billion or so in treasuries that they're running off their balance sheet every month, which is really a small amount. So if they end it, I don't really see that as a big market moving event. What it will do is help allay some of the fears in the repo market potentially.
Explain, Bob Michael. We need to do this, folks. It's a course here on the Fed Decides. Treasury Bill 101. We have more debt than God. The Secretary of Treasury has made clear he's comfortable with Treasury bills. Should our audience worldwide be comfortable that we're going to have massive issuance of Treasury bills in the coming quarters?
I don't think they should be concerned about it. When you look at money that's in cash, you can look at a narrow measure of money market funds, or you can look at a broader measure of M2, which includes deposit balances, checking accounts, and so on. There's a lot of money sloshing around in the system, and if Treasury bills cheapen up a little bit, that money will circle into it. There are also other things that could happen. One, stablecoin is growing wildly in the US. Treasuries are collateral for stablecoin, so you have a natural buyer base forming there, and nobody's talked about relaxing the SLR calculation for banks and removing treasuries from the denominator. The Treasury can do that. So you can even create larger buying pools for the front end of the Treasury market than what exists now.
I got to rip up the script here. It's too important. Richard Portis and his leadership at London Business School. I spoke to Professor Portis today. He has great concern about stablecoin. Your bank is known for a cautious approach here. You've amended that. But should we have worries when we study stablecoin, or can we say it's removed from the things John owns, Ethereum and Bitcoin and all that?
Well, I think you have to separate crypto and stablecoin. Stablecoin, which operates through the banking system, can be digitally tracked, it can be regulated, it operates within a banking framework. If it's collateralized by treasuries, it's safe. And then it allows transactions to occur 24/7, 365. There's none of this nonsense that on Thanksgiving, the rest of the planet's open, not in the US, you can't wire money around. Stablecoin allows you to do that.
I feel like you try and get me in trouble every time we have this show and do this program. I have to do this on a frequent basis. I am not limited on crypto. I wish I was.
You don't.
I wish I had been for the last 10 years. Too bad, right? But I am not. A question, though, does remain about the broader asset class and what's happening with risk assets beyond just crypto. We've seen some stellar rallies this year. In fact, Bob, everything has rallied. Stocks have done well. Government bonds, 10-year bond yields have done well in this country. Beyond, say, just FX and the US dollar, risk has done well, credit's done well, crypto's done well, gold's done well. What hasn't done well, and is this Fed getting lulled into playing a role in blowing up some kind of asset bubble?
Well, that's the interesting question. For me, I learned a long time ago, in the world of bubble spotting, you take the price of something and plot it on a logarithmic chart. When you start to get upward curvature, jump in, because that last year is the big one, and that's when the bubble's forming. We don't see a lot of that yet. You can plot the NASDAQ, and it's going up at a pretty steady pace. I think there's a healthy recovery post-COVID and still post the GFC. And I feel the US economy and corporate America, it's finding its feet. Yes, everything has gone up in price, but the Fed does have specific things to respond to. The labor market, and also what looks to be a neutral rate. And inflation's not at this 5 or 6%.
Subhadra Rajappa of SocGen still with us. Subhadra, I want to bring you into the conversation on that. Is this an issue that the Fed has to weigh? Maybe not at this meeting, but over the coming meetings, how they're contributing to broader financial conditions?
Yeah, I think it's definitely a concern for me. And to me, at least the way I look at it, this doesn't feel like the environment where the Fed should be delivering a lot of preemptive cuts or cutting as much as what the market is pricing in by the end of next year. To me, that kind of path feels like it's a little bit aggressive. I mean, the growth trajectory for the third quarter has been extraordinarily strong. You know, the Atlanta Fed GDP now is tracking close to 4%. You're looking at an employment picture that's kind of deteriorating, but not terrible. Inflation is still high and sticky and well above the Fed's mandate. So to me, the market kind of getting ahead of itself and pricing in too many cuts seems like it's a bit much. And then you add in easy financial conditions, you're left with an environment where maybe the Fed has some sort of leeway in trying to not ease as much in this environment.
Subhadra, I'm going to pick up on Bob Michael's insight there about what I call log convexity. Are you seeing out there not bubble tendencies, but are you seeing on a log plot, a logarithmic plot, a convex acceleration where things are getting a little bit effervescent out there, a little bit exuberant?
So to me, what is concerning is the fact that there's absolutely no volatility in the market. Look at, bond volatility. You look at implied volatility in the bond market or in the equity market. There's absolutely no concern. So to me, the lack of volatility in this environment is also troubling because you tend to see a lot of investors kind of getting lulled into a sense of security and continuing to sell vol anytime you have a pop and vol. And that's an environment that is concerning, given the fact that we do have a decent amount of risk. We're going through a shutdown right now. There's potential for meaningful deterioration in a lot of these fundamentals that we're looking at. We have no clarity on the data. So I think a little bit of caution is required from that perspective.
Subhadra, somewhere in this country, there are some college kids, maybe the Finance Society at the University of Alabama, taking bets on just how soon this news conference will end as soon as it starts. Are you betting on a short one today? What can he possibly say about what they don't see at the moment?
He's going to get his slew of questions from everyone, including Mike McKee. So the press conference will probably at least run 30 minutes or longer. He might get into the details on QT if they do announce QT. So I'd be curious to hear what he has to say. And he's probably going to also kind of elaborate on the data points that he sees, because the Fed does have a lot more information that's available to them. And he might kind of enlighten us a little bit more on what they're seeing and hearing from their constituents. And that should shed some light on what they're thinking on policy. We'll also be curious to hear what he says on what he's going to be doing at the December meeting. Although they don't have a whole lot of information, the market's already fully priced in a cut. We'll have to see how he kind of discusses that.
Subhadra, thank you. It's good to see you. Subhadra Rajappa of SocGen. Those college kids will bet on anything, TK. You notice that these days? Absolutely anything.
Yeah, I've been in front of some of them recently, and they're eager to learn, and their heads are spinning like ours are spinning over this moment we're living in. I'm still saying it's coming out of COVID. We're maybe beyond that somewhat here there, but now we have this shutdown. You said the word when we came in here in our show preparation. The first word out of your mouth was odd.
It's an odd one.
You said it's an odd meeting.
The only data we have, the most recent data, the only data we have is inflation and headline and core around 3%, and the Federal Reserve set to cut interest rates at 25 basis points. I understand why, because they're worried about the labour market. But it's a kind of awkward situation not to have that official labour market data and still to be looking to cut interest rates with inflation around 3.
And again, the dovish, hawkish tilt of a traditional Fed meeting, maybe it's out the window. We'll have to see.
That Fed decision just around the corner. Let's check out the market. Start with equities. Equities this afternoon positive for a 5th consecutive session on the S&P 500, up by 0.2. In a bond market on 2s, 10s and 30s, a snapshot of fixed income yields higher at the front end of the curve by 2 basis points, likewise on 10s. With that Fed decision, here's Mike McKee.
A divided Fed cuts their benchmark lending rate by a 1/4 percentage point and says they are going to end QT December 1st. There are 2 dissents as policymakers reset the target range to 3 3/4 and 4%. No surprise, Stephen Byron dissents in favor of a 50 basis point cut as President Trump wants. And Kansas City Fed President Jeffrey Schmidt dissents on the other side in favor of no move. The Fed's administered rates for interest on reserves and the primary credit rate mechanically decreased by a 1/4 percentage point along with the Fed funds target. As for the balance sheet, the Fed will stop redeeming maturing Treasury securities at the end of November. Principal payments will be rolled over going forward. The mortgage cap of $35 billion a month remains in place, but as of December 1st, all principal payments on maturing agencies will be reinvested in Treasury bills. Fed officials gave a nod to the government shutdown in their economic assessment, noting that, quote, available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting downside risks to employment rose in recent months instead of have risen. And uncertainty about the economic outlook remains elevated, they say. There is no change to their forward guidance. The statement still says, in considering additional adjustments to the target rate, they will consider many factors. Guys?
Mike McKee, stay there. What a decision by the Federal Reserve. So you cut interest rates 25 basis points, widely expected. They end QT. A lot of people were talking about that coming into the decision. But the headline here is just how divided this committee is. Dissent cutting both ways. One saying keep policy unchanged, another saying let's go even harder and come by 50 basis points. Equities stay elevated, up by 1/4% on the S&P 500, but a bit of a turnaround in the bond market. Switch on the board and gets the fixed income. 2s, 10s and 30s. Bond yields just slightly higher by 3 basis points on 10s at 4.01%. TK, these aren't major moves in financial markets, but there is a subtle shift in this Federal Reserve. It's divided. And when you're this divided, it's difficult to provide guidance about what you're going to do next. Because if you're trying to lead this committee, trying to reflect a consensus that doesn't exist is basically impossible.
Edge of Bank of England. It's the first thing I thought about. I've got to go back and study when the last time this really happened, where you had one up, one down, one hawkish, one dovish as well, pushing against the chairman. And it speaks to the 2 parts of the country that are out there. My idea that there's 2 R-stars. You see it with the shutdown again, and part of America flat on their back. You've got, it's amazing to me to see Myron 50 beeps in, John, and let's say you want to go the other way, it's a 75 beep gap. I don't believe I've ever observed that. I'm sure I'll stand corrected, but there it is.
The last time we had a dot plot, there was massive dispersion. I think you know whose dot's at the top now, and we knew whose dot is at the bottom. Mike McKee, I believe you're still with us. Mike, the credible argument here, are there credible arguments to do nothing and credible arguments to go even harder?
Well, the credible arguments to go even harder are a little bit harder to make because financial conditions are pretty easy right now, and the markets have been soaring in recent weeks. No change there. We did see interest rates rise a little bit this week as perhaps the markets got a little concerned about inflation going forward. Jeff Schmidt's case is probably easier to make in the sense that inflation is still rising, even if we are seeing the Fed cut rates. That could only be a problem going forward, is his view. view, and there are people on Wall Street who certainly share that.
Michael McKee, thank you, sir. You get into the news conference. Mike McKee there breaking down this decision. The Federal Reserve reducing interest rates by 25 basis points this afternoon.
2019, we had George and Rosengren say no rate cut at all, and Bullard said a dovish dissent. That's some of the tension, but I would suggest today's meeting has even greater tension than what we saw in 2019.
Bob Michael at JP Morgan Asset Management still with us. Bob, just your early reaction to this call and that dissent.
I don't think it was at all surprising. The two dissents could have been a bit more interesting. I think Myron could have gone for 75 basis points. After all, he wanted 50 last time. Sure. So there's 25 that he's owed, plus another 50 this time. That would have been fun. And Schmidt, where was he last meeting? Where was he last meeting? Now you've had more evidence that the labor market is feeling a bit spongier and inflation's not as much of a threat as we thought back in September, and suddenly he reemerges. To me, it tells me that Powell is losing his grip on the Fed.
Let's extend the conversation with the former Fed Vice Chair, Rich Clarida. Rich, welcome to the program. Bob Michael saying the chairman might be losing his grip on this Fed. Do you agree?
I don't think so. You know, going into the September meeting, I thought we might see President Schmidt dissent. And so I do think Powell really focused in September on keeping the committee together. But I expect to see more of this in the remainder of Powell's term for sure. If you just looked at the dots in the speeches, you have a pretty divided committee in terms of the case for preemptive cuts from here with inflation at 3%.
Richard Clarida, I've got to ask you the important questions here about the future of the Fed as well. John Farrell mentioned the Secretary of Treasury would make a pretty darn good chairman. That's out there in the zeitgeist right now. How important is this date of October and moving into December and really firming up the debate over the next chairman of the Fed?
Well, they have indicated, and I do expect that the White House will announce the nominee by the end of this year. And I think it is important because it will take some time for that person to get confirmed, and the transition will be relevant to markets. You know, the short list says anywhere from 3 to 11 names, and perhaps you could add Dissent to that. So still a lot to figure out.
I mean, it'd be interesting to see how we figure it out if we assume a December rate cut. John, that's pretty much consensus, right?
I don't know, Tom. You know, I really don't. Are we going to have some data? Does the government shut down?
We may get some data. We'll have to see.
Do you get a bounce back in the labor market?
Where are we going to be in January? I mean, I need to understand the vision to get to January in that room that you as vice chairman have been in.
Well, I think you go one meeting at a time. I think, especially where we are, given the uncertainty about the data flow. But Tom, I do agree with you. I think it's just natural as we move into 2026. You know, markets are forward-looking, and markets are going to have to telescope in what they expect the new Fed chair and what his or her priorities to be. And so I think December is something we'll be looking at, but then as we get into next year, that becomes relevant to markets.
Hey, Rich, TK often brings up the Bank of England and the amount of dissent we get over in the UK on Threadneedle Street and the difference with the United States. I think we've been conditioned by the leadership of Greenspan just to believe that the chairman has this immense power to lead the whole committee. Rich, do you think it's going to be getting difficult and more difficult to govern this committee into next year, even if you select a super dovish Fed chair? How hard would it be to get things your way?
It's a good point, John, because in practice, you know, and I do it myself, the Volcker Fed, the Powell Fed, but it is a committee. It requires votes of the Federal Open Market Committee. Oftentimes inside the building, the power of the chair is the power of persuasion. We've had some pretty persuasive Fed chairs, but there have been dissents. I think the key thing that we might start to see more of is dissents by governors. In the last 30 or 40 years, dissents really since Greenspan have been typically concentrated among the Reserve Bank presidents, and so that could also become a factor as well for the new Fed chair.
Rich, let's spend some time on this news conference. I imagine there'll be questions about what is guiding this interest rate decision, and for that matter, to Tom's point, what will guide the next one? Let's assume the government's shut down. Rich, what is the data they can point to right now they're going to be leaning on, and how do they really flesh out their reaction function to non-traditional indicators? I think we're all familiar with how they respond to, say, non-farm payrolls, the unemployment rate and CPI, but if you don't have that anymore, Rich, how do you communicate?
Well, it's tougher. There are alternative sources, ADP for employment and, the Billion Prices Project for prices. But I would agree, John, the further this goes on, the trickier it gets really to make an affirmative case, especially right now. Let's be honest, the justification here in September and now is really a risk management consideration. And, but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment. So risk management becomes trickier as well with little data.
John Farrell and I took Behave Yourself 101 and Don't Be Rude, so I'm not going to ask this of Vice Chairman Clarida. I'm going to ask it of you, Bob Michael. We have Chris Waller with a definitive 1991 paper on game theory and the Fed. He and I covered that the other day. We have Richard Clarida with arguably the definitive 1999 paper on not so much the history of monetary policy, but the mechanism that we have. How critical is it to you and your bank that we have a next chairman who has prodigious monetary chops?
It's important. You need to have someone there who understands that the Fed, I believe, controls the purse strings to the U.S. economy. So it's an awesome responsibility. I think Rich hit the nail on the head. You don't only need a dovish Fed if you're the administration. You need a persuasive appointment to head the Fed. And that's a rare combination. And there's one guy we know in the administration today who's been shockingly persuasive. If you go back to April when everything was falling apart, who's the guy who stood on the White House lawn and calmed everything down? That was Scott Bessent. And I think you have to put him into the Fed if you're the administration and you want to see rates at 3% and lower, and have him lobby and create the persuasion.
But on a daily basis, he's monitoring his president. He's assisting his president as Secretary of the Treasury. That's a huge vacuum if Bessent goes over to the Eccles building.
Yes, but as you said, you need some street cred, and he's got it from being Treasury Secretary. And he does have a view. He does believe fundamentally that a lower interest rate environment frees up businesses and households, and ultimately that's good for the U.S. economy.
Bob, I think
you can't fault him on that.
Both you and Rich are exactly on the money, and a lot of people following this situation agree with you. TK mentioned Neil Datta a little bit earlier on in the programme. If you want a Fed chair that's going to lean towards rate cuts and can influence and persuade the rest of the committee, he's already on the FOMC. It's Governor Chris Waller.
Yeah.
The outstanding question at the moment is whether the president wants to go along with him. Rich, you've sat in the room with the president of the United States and you've had these conversations. What are the interviews like, Rich? What does the president ask?
Well, that's probably for my memoirs. I enjoyed the interview. It went quite well. But let me just say this. You mentioned Chris Waller. I had the privilege of working with Chris closely, and I admire him as an individual. I admire him as an economist. He's had some good macroeconomic calls, and so there are other strong candidates as well. But Chris checks a lot of those boxes for sure.
Rich, we'll keep you out of trouble. It's good to see you, as always.
Please,
the former Fed Vice
John.
Chair, Richard Clarida. Rich, thank you.
We don't want to push enough.
He wants to sell books in a few years, TK, and tell everyone about those interviews. Diane Swanker, KPMG, jumps on now. Diane, welcome to the programme. Decision 15 minutes behind us. About that news conference, about 15 minutes in front of us. What's the big takeaway this afternoon?
Well, instead of a dual mandate, we have a dueling mandate, and that's what you saw. We had 7 people that had on their dots either no cuts or only the one cut that we had, and dissents are rarely done in a vacuum. And I think Schmidt's dissent was also in line with another 6 of those 19 participants that did not think we needed any additional cuts right now. And I think that's what was important. I think it was very important with the first meeting with Governor Moran at the table, knowing that he was going to dissent and be an outlier on the dot plot, that you showed solidarity within the Federal Reserve. But we are going to see a lot of tension going forward because this is a really difficult time. 1, we're flying blind. 2, we've got inflation is up and unemployment is edging up as well, and the labor market is slowing. You add all of that together and you get this sort of stagflation whiff, which is what makes this Fed likely to have more dissents that go in both directions going forward.
Diane, as always, absolutely nailing it. And Dan, in many ways, not news, because we saw this in the dot plot last time around, just massive dispersion, a huge difference across the board with different Fed officials and what they expect policy to change and how it's going to change in the year to come. Dan, you mentioned inflation, and I think we've got to talk about this. This is an interest rate cut that comes a week after an inflation report that showed inflation at 3, not at 2, but at 3. How credible is that pursuit of 3%, given that we've missed that 2% target, for so long?
Well, that's what the concern is. The argument, I do think that Jeff is sort of on a little bit firmer footing here. We know that this is a risk management cut. It's not clear that rate cuts alone will actually stimulate employment in this economy right now. I think there's some structural issues that are suppressing employment, which makes it much harder for the Fed to actually have an impact on employment. And lower interest rates tend to accrue to higher income households more than they accrue to lower income households. So, that doesn't help the inequality problem that we already have out there. But I think it's really important to understand that we've got this situation where 40% of that CPI was imputed. Many of it is credible imputations where they get an easy substitute. Some of it's based on history. And if prices are changing on a real-time basis more rapidly, we don't know that. The other concern is that we have had more than 4 years where the Fed has not, the proximity to pandemic inflation, had price stability yet. And that gives us a muscle memory that ups the risk that this is not just a look-through moment. That is the Fed's, certainly Powell's base case, is it's a look-through moment with a hedge. We don't want to go too far. And I think that's very important, is that you've got sequencing of tariffs that mimics inflation, and it ups the ante that we get a more persistent bout of inflation. The Boston Fed came out October 9th with a study saying that they thought inflation expectations are becoming unmoored.
Diane, from the NBC affiliate in Chicago, I think this is so important. There's 1.9 million people in Illinois that are in food lines. In November 1, it's over. It's $187 a month benefit for food, the SNAP program in Illinois. I understand that could be fixed in one moment as the president, the Democrats decide to end the shutdown. But given that, the chairman must address that in this press conference. How will he do that?
What Powell has always done is said we're doing this for the American people, and he'll lean into those issues. I think one of the issues, the 750,000 people that are either furloughed or working without pay at the federal government, the collateral damage on contractors as well, and the ecosystems and entire communities in which they live. And now 1 in 4 children, you're talking about losing food stamps or the SNAP funding. That is huge. And, children with hungry bellies can't learn. This is very important. In fact, my son's birthday is in a week and a half. And the one thing he asked me for his birthday is to donate to the local food bank, because he sees the lines already. And I think this is, I talk about breaking bread is better than breaking ties. This is a time to share your bread, because it's very hard for too many.
I totally agree with you, and we all do. I think that sentiment is shared by everybody who watches this program. The risk is for a monetary policy official is that they become seduced by that argument and get themselves in a wealth inequality game and fuel exactly what they're trying to prevent. Because, Dan, if you've got assets right now, game on. Keep cutting interest rates.
Yep.
Dan, what difference does it make to the people struggling in this country at the moment? The Chairman Powell and the committee cut rates by 25 basis points. And how does it tackle wealth inequality? That's the risk for the chairman. That's not his job. That's not his mandate. Right. The politicians in D.C. need to address that.
Absolutely, and that is the problem. And I've actually heard people say, hey, the Fed should cut rates because low and middle income households are struggling, it will help subprime. No. It won't. The subprime rates are so much higher that a quarter point is not going to change the affordability and the ability of those households who are already in duress to actually service that debt. And we know that from the 2010s, the inequalities worsened. We're now at what looks to be the worst inequalities we've had of the post-World War II era. 20% of households carrying the economy, 3.3% of households really driving those gains, the bottom 80% unable to do anything more than keep up with inflation. That is why the overall consumer, the overwhelming majority of consumers, feel more down about the economy than the actual economy looks like on paper. And that's because we're seeing an AI-driven boom. We're seeing a wealth-driven boom that's concentrated in very few firms and in very few households. And it's not accompanied with jobs. And those productivity gains are not showing up in wages, and they're not ameliorating inflation. So it's a very tough situation for a lot of households, but a rate cut of quarter point here or there may not even change it. And as I mentioned earlier, some of the job losses that we're seeing and the ones that are being announced are structural, not cyclical in nature. And that means that a cut by the Fed is not going to cure that problem.
Dan Swunk, Clinic, as always, wonderful to hear from you. Dan Swunk there of KPMG. Bob Michael, I want your reaction to that. I think it's so important. We've had a massive step down in payrolls. But to what extent is that cyclical? And to what degree is it structural?
Believe a lot of it was cyclical, and it is becoming structural because we know AI is here today. It's no longer on the horizon. It's being used across businesses to achieve efficiency. I think the question the Fed has to answer is just how blind are you flying? And the only answer Jay Powell can give is, we're not flying blind at all. We've got 400 or 500 analysts and economists at just the FOMC alone. Plus, we've got all the regional banks that have hundreds of economists. They're talking to businesses every single day. We're accumulating that data. Here's what the data is telling us. That's what I want to hear at the press conference.
The summation, Bob Michael, of your fan distributions, this thing, this discussion, that debate, do you have confidence forward in your guesstimates that you're making minute by minute? You read Kasman, you read Feroli's weekly prospects, you sum in globally JP Morgan's fixed income abilities. Do you have confidence in any form of fan distribution forward?
I do, because what we see is a Federal Reserve that believes that a neutral rate is closer to 3%. So they're headed in that direction. We're not so concerned about inflation, even with the one big beautiful bill hitting, because you do have tariffs that are some magnitude of headwind, hence 1.5% GDP for the next couple quarters. And then you also have AI, and granted it's a two-edged sword, but that will create some efficiency. Those two things are going to be offsets to sticky inflation. We'll see how it all balances out.
Should I ask the pregnant question?
Go on,
Have you
please,
let
Dave.
artificial intelligence into your new palace?
It's everywhere.
Literally. Okay, pregnant pause there, if we can call that. Okay, if you're just joining us, welcome to the programme, live on TV and radio. A Fed interest rate decision about 21 minutes ago to cut interest rates by 25 basis points. Dissent cutting both ways. Governor Myron pushing for 50 basis points. President Smith voting in favour of keeping interest rates unchanged. Something that we haven't talked about a lot in the last 21 minutes that we're going to talk about now is an end to QT. The Federal Reserve deciding to stop shrinking the balance sheet. Matt Lazzetti of Deutsche Bank was looking for that move. Matt Lazzetti joins us now. Matt Lazzetti, what are the consequences of that call today?
Yeah, I think the Fed is simply responding to the increase in funding pressures that they've been seeing in recent weeks. We've seen the Fed funds rate beginning to move up within the corridor. And I think we've always known that the Fed was going to be very cautious in their balance sheet decisions this time around, wanting to avoid what happened in September 2019, where you saw repo rates really spiking. The Fed funds rate moved outside the corridor. And I think they were just going to be always very cautious in handling that this time around. And I think that's why you got the decision today that you did to end QT beginning in December.
Matt, what does this interest rate decision achieve? What does it do? What's the channel through which that rate reduction is going to work?
Look, I think these are all quite small moves. 25 basis point rate cut was already priced in, so it's already kind of reflected in broad financial conditions. But I think it'll help to continue to support, equity valuations that are high, credit spreads that are tighter. It'll filter through into lower front-end interest rates, so help on credit cards and auto loans eventually over time. We'll have to see what happens with mortgage rates. As the chart shows there, actually 10-year yields are moving up on this decision, not down, and therefore it may not help on the mortgage rate side of things. things. But I think it's more so not necessarily the decision today, but what is the Fed going to be doing over the next 3 to 6 months, next 6 to 12 months, and how much are they going to be cutting rates over that period of time? That's what really is going to impact financial conditions.
I'm curious, Matt, if the chairman brings up productivity here. The smartest thing I've heard in the last hour as we've done this is from Bob Michael, where he said of his new palace at JP Morgan, AI is everywhere. How is the moment changing? I guess, how is the guess that you have of this moment of AI? How is it changing your view, your overlay of productivity?
Yeah, I think the productivity story is really the critical question for the Fed at the moment. And we heard this from Governor Waller in his comments before the blackout period. And it's really because we have this huge divergence between real GDP growth that is very strong, almost 4% in Q2. Atlanta Fed is tracking almost 4% in Q3, but a labor market that's weakening kind of meaningfully at the margins. And that is being explained by strong productivity gains. My own view is that, yes, some of this is due to AI, but it's mostly reflecting a very tight labor market that we had in previous years, which motivated businesses to undertake CapEx and capital deepening and find efficiency gains. Many of the productivity gains I think that we are going to see are actually further in the future. But this stronger productivity story for the Fed, I think, is one which suggests that rates most likely should stay higher over a longer period of time, that our star is eventually going to be higher as well.
Michael Feroli will write on this on Friday. You have to think about it in real time as seen in yield. A given company, we're showing 30,000 a door. Another company, we're showing 14,000 a door, and on and on and on. How do you, with all your experience, treat 5-figure job reductions at America's finest companies?
Yeah, you accept that it's the economic reality. You accept that we're in the very early stages. You hope that new industries and businesses will be created off of the back of AI that will employ more workers, and there will be a greater efficiency. We saw that when the electronic spreadsheet replaced manual spreadsheets. We saw that in the dot-com era. Hopefully we'll see it with AI.
Robert Kaplan, the former Dallas Fed president, was just wonderful on this the other day.
What did he say?
He said hope. He said just what Bob Michael said. It's one big academic hope by the haves that there's a good side on the other side of AI.
Luke Cower, I think, has been absolutely brilliant on this. This is regressive up front. Can hold back employment. In the near term, I hope that changes. It can boost energy prices. Electricity in this country is becoming the political topic.
Agreed.
For the next
Strongly
18 months.
agreed.
Now, the argument you've got to make is that's all going to change. Productivity picks up. Great. Fantastic. But in the here and now, isn't that a bit of a stagflationary story? If you strip out what is happening, say, with energy prices, electricity taking off, if you look at what's happening with labour market, holding back employment, isn't that a bit of a problem for this committee?
I don't think so. I think that they're comfortable looking through inflation, and if there is a problem...
no doubt. They've done that for 5 years.
But if there's a problem in the labor market, that in and of itself will hold back some inflation.
We have 25,000 employees. You are the most qualified one I know to talk about electric bills. What does America face if we have some semblance of the electric bills of Britain?
I know, Mum. Don't worry. I'll take care of it at the end of the month. It goes something like that.
That's how it goes.
Yes, it does.
Okay, that's real, folks.
The energy prices in the UK are absolutely brutal. They're absolutely brutal. And if you face anything like that in the United States, you're talking about the wealth inequality in this country right now. We're lucky to have the energy prices we have because they're so much lower compared to some other individuals, some other nations in the G7. If they face that same situation here in the United States, imagine the midterms 18 months from now. Imagine the local politics and the support for those data centers. What's that going to look like? You tell me.
Governor of Virginia on 14% lift in energy costs in
You're going to want that
Virginia.
data center? How many people they're hiring?
Yeah.
I know what it's doing to electricity prices. How many people they're hiring? Not many. It's pretty Labour light. Matt Lazzetti of Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there of Deutsche Bank, breaking things down, called correctly the end of QT. That's exactly what we got about 27 minutes ago. Bob Michael, you're fantastic at this. Going into the news conference, questions for Chairman Powell. What would you like Mike McKee to ask in a moment?
I think he's got to press them on what are they seeing from their own sources of data? What are they seeing from the regional banks and their thousands of economists? They're talking to businesses every day. They didn't make this decision blind, much as it creates a wonderful narrative for the three of us. They reacted to something. What was that?
What do you think the next decision hinges on? What are the metrics? If we don't have the data, let's say the government's still shut down, what's the next decision hinge on?
I think it's going to be anecdotal evidence from businesses If they're still in a pause, higher and fire, doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say, a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399, what's your call 12 months out?
Well, let's start with Fed funds. We see that around 3 3/8%. I think you're going to see the 10-year somewhere around 3 3/4%.
Okay.
Bob Michael, JP Morgan, this was fun. It's good to see you.
Always a pleasure.
Thanks for dropping by.
Great.
We've said a few times on this programme over the last few meetings that these meetings are going to get harder and harder for this Federal Reserve. At the next meeting, when Chairman Powell convenes things, think about things. Today, the good news, no forecasts. Imagine how difficult it would be to provide forecasts in a moment like this. At the next meeting, can't escape it. This committee will have to put together forecasts for 2026 with the potential of not having any data at all. And even if they have the data, that data could be very, very messy. On top of that, Tom, we might have that shared decision from this administration, which will take away the ability to guide into 2026 anyway.
On this Wednesday, all this talk here as we go to this conversation, the questions and the answers, we have to remember that in, what, an hour and a half, these mega companies are going to show profit and cash flow that is not in any of our textbooks.
This is why, Tom, so many people right now are so bullish. What matters to the equity market? Not payrolls. I've said a few times, if I told you the payrolls data at the start of this year, at the start of 2025, you would have been hopelessly bearish on this market.
Correct.
What's mattered to equities has been earnings. What's mattered to the man that's about to step into that room is the step down in payrolls. So the market gets the best of both worlds, gets the earnings one and gets the interest rates reduction as well, too. And the man who's about to step into the room is going to deliver potentially another 25 basis point cut at the end of the year. That's the reason why so many people right now have been bullish this equity market. Equities into this news conference at all-time highs on the S&P 500 up by 0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are what are the pathways through which it could become something else, troublesome inflation? One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data. But you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our job. So that's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth. That the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views. So on that division then you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on. But it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths, maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Mike.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is the you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing. And as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it, and that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, you know, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. You know, we're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But you know, we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, you know, the stock market, it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the, in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
That wraps up the news conference from Chairman Powell following a decision to reduce interest rates by 25 basis points. Credit to that reporter and to Mike McKee for actually asking about financial conditions and financial markets. If you are just joining us, welcome to the program. Equities recovering. There was a drop-off as soon as Chairman Powell started to speak. We're back to about negative 0.2% on the S&P. The bigger losses on the Russell, the small caps down by 0.8. In the bond market, off the back of these comments from Chairman Powell, bond yields higher at the front end of the curve by 9 to 10 basis points. A 25 basis point reduction from the Federal Reserve, two-way dissent, the limited ability to guide from here, and these comments from the chairman of the Federal Reserve. Take a listen.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. At a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
A December rate cut is far from a foregone conclusion. That was a prepared remark. It was scripted. TK, it was heavy with intent.
I love when they look down at the script. I mean, you wonder what percentage of the press conferences.
I think, to be honest with you, Tom, it gave it extra meaning. That was
absolutely.
The intent to come into this room and tell everybody, including Wall Street, we're not making a call on December.
Calm down. We're waiting on it. When we get to Torsten's Slack, I want to really dive into that. I need to frame this, John. I think it's so important. We've had this spectacular move lower in the 10-year yield down to 3.9 whatever. OMG, we've come back 4.05% at 7-8 beeps move. It's only center tendency on two standard deviations. We're by no means. Price has not cratered in the last 20 minutes.
Low end of the range for the year still. Yeah. Totally with you. Bond market's been super well behaved. When the Fed last met back in September, 2s were near 350, 10s were near 4%. Right now, TK, 2s near 360. 10's near 4%.
There's going to be a lot of hyperventilation about this tomorrow. I'm also looking at the currency market, which I think is extraordinary, into the Trump-Xi meeting. And, you know, it's a side story. I get it. It's not the Fed decides. It's maybe the president decides on trade. But it's a backstory to this that will be interesting the next couple days.
Dollar strength this afternoon. Euro dollar 115.82. Euro dollar down by 0.6%. TK mentioned it. Torsten Slock of Apollo with us around the table. Torsten, good afternoon. Good to see you. What's the big takeaway for you from that?
Well, that they do have clarity on the CPI, on the inflation side, but there was a lot of questions about the labor market, and it was very clear that he came into this saying the labor market is still chugging along, moving sideways, slightly cooling, and he didn't mention any of the private sector indicators. So he did basically say, we don't quite know exactly what's happening in the labor market, but we still feel quite good about it. So that's why he came to the